Ready. Well, I think we're about 2 minutes past the hour, so we'll go ahead and kick it off. So thank you everyone for joining us today. We're really excited to discuss today's topic, which is titled Unlocking Your Investment Retirement Account. So today we have with us a very exciting guest, a good friend, as well as a really established industry professional within the retirement industry, Carl Fischer. And Carl Fischer has a very impressive background. So I think it's worth noting he's a Cornell grad. He was also a rocket scientist at Kennedy Space Center for many years. So maybe he could dive into that. And as well as he's the founder of CamaPlan, which is a self-directed investment retirement account. And we'll go into what CamaPlan is, what Carl does exactly, and just kind of unlock and demystify what it is that we talk about with retirement accounts. What's the difference between a 401k and investment retirement account, or IRA for short, Roth IRAs, and then even 401k IRAs. And so there's a lot of different acronyms and financial jargon out there. And so what we hope to do today is to really help you better understand how you are able to take advantage of the self-directed IRA, use your retirement assets that you've worked really hard for and have saved up for, to then take control of those assets and invest it in things that are not just stock, bonds, ETFs, mutual funds, what have you, but being able to take those assets and actually invest them in passive real estate investments, such as the ones that Cover Capital we buy and invest in. So with that, Carl, I hand it over to you. I see you're sharing your screen. Can you just kind of quickly go through what CamaPlan is and what you guys do?
Sure. We founded CamaPlan approximately 20 years ago, the end of 2003, basically September. So what we did is we found out that a lot of people like myself know real estate. My mom and dad were in real estate, and their moms and dads were in real estate. So when I found out that I could invest in real estate instead of stocks and bonds, which I'm really not good at, we founded the company after figuring it out and dealing with the IRS, et cetera. We founded the company because all the wealthy people knew about it and they were able to do it. And they told me I didn't have enough money to do it. I needed, $60 million back in 2000 or 1995. So we figured out how to do it, went through the hoops of doing it in the early 2000s. And now we make it available to individuals that want to diversify their portfolio, what I say, into things they know and understand. So that's how the company actually was founded. I was still working at the Kennedy Space Center at the time. They were giving away it looked like they were going away from the shuttle program and sending all the money to the Russians, and that didn't sit well with me. So it was a good segue into what I call my second career. So that's how we started it. We don't sell any assets. We just basically do the accounting work for the IRS so that people can invest in what they know and understand. So
That's
let me
awesome.
just kind of see what's going on here. There we go. So today we're going to talk about self-directed IRAs, 401ks, and other retirement accounts and other things there. We're going to talk about the types of self-directed investments you can do, and also navigating the rules associated with it, because there are rules that the IRS has set up, and we'll just briefly cover those. I'll give you the overview of how the process works, the logistics of when to do what, and it's pretty much like opening up a bank account and then picking what you're going to invest in. And then we'll go over some discussion points and allow people to ask their questions. Ben, if you can keep an eye on the Q&A, if someone pops a question up that you feel we should answer right then, please feel free to interrupt me.
Absolutely.
Okay, and I guess everybody should put their questions either in the chat or the Q&A or whatever you prefer, Ben.
Yeah, the Q&A function, just dump them into the chat and then we'll be sure to answer them as we go along.
Okay, all right, that sounds great. So understanding, so what is a self-directed IRA? This is a definition that we had an attorney draw up for us 20 years ago. There wasn't any Wikipedia out there on the subject, but there's a nice 2-page Wikipedia that you can take and read about self-directed IRAs there. But to keep it simple, which is one of my things that I try to do when I'm presenting, is this is an IRA that you can invest in anything except what the IRS says you can invest in. And that's primarily collectibles and life insurance. So just think about anything that you like to invest in that you're good at, that lets you sleep at night. Like I said, my family on both sides were in real estate, so I'm biased towards real estate and real estate related products such as notes and mortgages and PPMs or funds. So I really like that aspect of it. Right, investing in what you know and understand and can control. We found that most people just throw their statements in the drawer at home until tax time and pull them out. And we ask them why they do that, and they say we don't have time to research all these stocks and bonds. We just hope that we're going to have money when we get to retirement. So we like this process a lot better because there's nobody that watches your money better than you or your family. I said that once, and a wife popped up and said, no, he doesn't watch it near as closely as I do. I have to be a little bit careful of that. So there's different types of plans. We were talking about this in the beginning. There's tax deferred plans, right? And the first two are personal plans, independent plans, individual plans, traditional and spousal IRAs. The last four are business types of IRAs. And all of these, the main difference in them is the amount of contributions you can do. So you can have a traditional IRA and put in $6,500 to $7,500, depending on what age you are. But then a SEP IRA, you can put up to $60,000 into it, and a simple IRA, depending on what your age is, is $15,000 to $20,000. And then defined benefit plans, you can put up to $250,000, depending on how much you make. And defined contribution plans are 401ks and those types. And again, you can put in, 60,000 or a little bit more if you're over 50. I already told you I'm biased towards real estate. The other thing I'm biased towards is tax-free accounts, and that's the accounts over on this side or the right side of the screen. The Roth IRA is one of my favorites. Health savings account is my favorite, because the difference between these two accounts are when you put the money in the tax deferred account, you get a deduction on your taxes. If you made $100,000 and you put $5,000 in your IRA, you'd only pay tax on $95,000. If you did it on the tax-free side and you put $5,000 in there, you're still going to pay taxes on $100,000, but everything on the Roth or the health savings account is going to be tax-free when you pull it out. So that's the decision you want to look at when you're making your mind up. If you want the money now or later. I like to take it later because I think the government can change their mind, increase the tax tables, and then take more money out of me. So it's one less variable I let the government play with. But the health savings account is unique in its own way, because any money you put in that account, you do get a deduction for right away that year, but you also get to use it for medical expenses tax-free, that year or years down the road. And then there's other educational savings accounts and Roth 401ks. So Roths can now either be traditional and or Roth or tax-free, and that was just changed in the in the, a few years ago. So these are basically the accounts you can look at. And when I say IRA or qualified plan, I'm talking about these. People will say, well, which one should I have? And my answer is you should have as many of them as you can. So, have a Roth IRA personally, have a business 401k. If you've got, health needs, obviously do health savings accounts. And if you've got kids or grandkids going to school, look at educational savings accounts. So talk to your financial advisors and see how many of these accounts you have, but obviously leave enough money for you to live on. This chart is something that I thought I should have been taught in college, and I never was. And I took a couple of economic classes and some financial classes. But I call, there's 4 types of money, right? And the first type is the W-2 salaries or 1099 money. And let's say on your W-2, your income was $100,000. By the time you take that home, you're going to have about 60,000, right? The Fed's going to take somewhere between 20 and 40% of it itself, depending on how much you want. I just heard today that California's state income tax is 13.3%. So there's some more money. So in this example, I only took 40% for it. Federal, state, local, and then 15% if you're in a self business with Social Security and Medicare. And by the way, I've never had a president or a governor or a mayor or even somebody from the medical or Social Security office come in and ask me for a raise, right? Or tell me, let me help you get a raise. But as soon as you get a raise in your W-2 or 1099 job, you don't even see that money. It goes to them too. So they're cheering for you, but you never even hear it, but they love for you to do that. So I try to bend people's mind is don't worry so much about your W-2. Think about the other ways of doing it, right? And Ben, that being in real estate, you don't have to pay the Social Security and Medicare taxes, either from yourself or from the employer. So that's why if you made 100,000 in the real estate, you'd be making 75,000 because you wouldn't be paying that 15%.
Yeah, absolutely. We preach this a lot, and this is something that we subscribe to. And that top bracket there, that W-2, I know that all too well. And, I quickly realized that, that I wasn't nearly bringing home half or, a little bit more than half of actually what I was making on paper. And that's why I think real estate is just so powerful because, not only do you not pay the Social Security and the medical, taxes, but, a lot of that income can be deferred and, with 1031 exchanges and, using accounts like these, like retirement accounts, you really can, harbor up a lot of your capital and avoid, taxes that otherwise really just eat into your lifestyle and the amount of money that you're able to spend on things that are important, like health and family and college and rent and all the things that continue to increase. So yeah, Carl, you're speaking preaching to the choir here.
Carl, Ben was ready. When I bumped into him, I just happened to mention trailer park one time. And he was on me and offered to buy me a coffee. And then I gave him 1 cup of the cash flow coffee that morning and he was hooked. It's like passive and cash flow is the way to go, and that was the kind of the lesson that our father Wayne Comfort preached to us when we were kids. It was like, he worked his butt off and he owned a construction company. And he just, at the end of the day, he just felt like he was treading water every year in, year out.
Yeah.
So
no, you're 100% right. If you go down to the tax deferred account, right? If you make that money, you get to keep that 100,000 and reinvest it. Obviously, when you pull it out, you're going to be taxed like ordinary income, right, on the tax deferred account. But just think about this, right? if you're able to keep that 100,000 in the third or fourth type of investment versus the first or second type, you're now investing $40,000 or $25,000 more. So it starts to grow exponentially as time goes on. You get to use that money over and over again. I say people pay taxes on their interest while I'm making interest on my taxes when I use one of these qualified plans, right? And if I make 100,000 in the tax-free account, I get to keep that, all of that money. And just as an example, this shows the comparison. The blue chart, you know, over 40 years, you start with $50,000 in 10 years, right? And I think it's a 10% return. But you look at it in 40 years, on the one account, you've got 750,000. You know, in the IRAs, you got 2.2 million. In the Roth, you get to keep the 2.2 million. And this is the exact same investments, but just taking into the fact that you don't have that money to invest and just keep compounding. But it's still better to even be in the traditional account. It's twice as much. So if you think about this, if you take 30 minutes and open up one of these tax advantage plans, look how much money you make over that period of time for that half hour you spent. All these investments are exactly the same. So that's a really good return on your 30 minutes opening up an account and doing those investments through it. And that, you know, and I don't care if it's stocks or bonds or real estate, whatever it is. In real estate, these numbers go way up because you generally, or people we deal generally make better returns than 10% overall and better than they do in the stock market. Again, maybe it's because they're not good at the stock market. I think there's more risk in the stock market, at least for me. So does this make sense to everybody, just for having it in a tax advantage plans? And nobody talks about this, right? There is no sex and sizzle. This doesn't make it to the dinner table as a conversation. It falls behind your vacation and a lot of times what's on TV. But this is what I'm drilling into my own kids. And I just had a grandkid 2 days ago. So I've given him a blanket with this on it, you know.
There you go. Congrats, Carl. That's awesome.
Thank you. So the types of investments, let's talk about those, right? Allowable investments, real estate, notes and mortgages, you know, so if you don't want to own the real estate, you can actually be a mini bank and put a loan on a piece of real estate. I like that. I think that's secure, right? It's hard for somebody to steal a piece of property. I can drive by it and see what type of condition it's in, et cetera. And then there's private placements, right? Different funds and different syndications that deal with a lot of real estate. And then others do precious metals, and we have some that do llamas and other types of things like that. And obviously you can be diversified in a number of different real estate assets as shown here: single family apartments, land, foreign properties if you want it, leveraged and unleveraged property, mortgages, promissory notes, trust deeds, leases. So you can see there's all kinds of ways to get into real estate and what we call passive income, right? And by the way, I don't think owning a single family home, you know, with a manager is necessarily passive. I like different funds, you know, where you know, as I get older, when I was younger, I was a control freak and did want that control. And I watched every screw go in the drywall and every plumbing fixture be installed, etc. So
Carl, can I ask you a question while you're going through
Sure.
the investment types that are allowed underneath CamaPlan self-directed IRAs? I get a lot of questions sometimes from clients that say, hey, I have a self-directed IRA. And I'll say, well, who's it with? It might not be a true self-directed IRA. And they say, no, it's with Fidelity or Merrill or, go down the list, right? TD Ameritrade. And they say, it's a self-directed IRA. It says right here. What's the difference between, a self-directed IRA from, say, like Fidelity or Merrill to a self-directed IRA that we're talking about through CamaPlan?
That's a great question. And the real word I like to use and focus on is truly self-directed. It's a little bit like having a chef come to your house where you can cook whatever you have there versus going out to a restaurant. You have to pick from the menu. So at Schwab and Fidelity and all the brokerage houses, you have a menu or whatever they sell, you can pick. You don't have to go into a mutual fund or let them do it, but you get to pick what's on their menu. At CamaPlan, we don't sell anything, so you can basically choose whatever you're good at wherever you want, right? Maybe you're good at houses in LA, other people are good at properties on Padre Island in Texas. So you get to use those differences. Schwab and Fidelity won't allow you to purchase anything that they don't sell.
That's helpful. And then maybe just to put a finer point on it, and I don't want to skip ahead, I'm sure you're going to cover this, but if say one of our clients, came to us and say, hey, I really want to invest in this upcoming deal. I have some money sitting in my retirement account and I'd like to invest it into this deal. How do I do that? Merrill, Fidelity, or Charles Schwab won't let me do it. So what would you suggest them to do if they want to say, hey, I want to go through, say, CamaPlan to do that? What are those steps and how does that look? What does that look like from a real life scenario?
Yeah, I'll show it to you here in a minute, but the quick answer is you'll open up an account with us, transfer the money over, and then purchase your deal. But I'll go through those individually on the mechanics in a minute here, if you can wait.
Yep.
And then just also to be clear for our listeners that are kind of interested in our deals, we are doing private placements. That's the category that we fall into in LLCs. And you're buying membership interest in an LLC with your money from these different types of retirement accounts.
Yep. And we do got a question as well. So, Carl, maybe we could just answer this one live. I believe you and I have discussed this before. It's an accountant, Marlene. So she's asking about the unrelated business income tax for IRAs. Can you touch on that?
I can. Unrelated business income tax. If you're running a business, if you're doing a lot of flips and your houses are considered merchandise, then there could be unrelated business income tax. The other one that generally hits people is if there's debt involved. Let's say they don't have enough money in their IRA to buy a property, depending on where you are, you're buying a $500,000 property, you have $250,000 in your account and you borrow $250,000. And then you have $50,000 worth of income comes in on that property. You pay off the interest and the debt. You also get to take 50% of the depreciation, but you're going to be taxed on you could be taxed on basically 50% of that profit, which would be $25,000, but then you're going to take off probably $15,000 for depreciation. So now it's down to $10,000. And you fill out a form 990T and you'll come up with whatever that tax is. And the reason that government does that is because you're taking money out of circulation for an IRA or 401k, and they feel that they've got to make some money on there because that money could have gone to a business or somebody else that would be taxed. And somebody said, well, why wouldn't everybody do this? Because they have unrelated business income tax out there. Otherwise, all businesses would be in IRAs and 401ks. So, and you couldn't take that money. But I don't, I look at each deal and then decide if I do have to pay that tax, is it worth it? I don't want, I like I said, I use a lot of Roth IRAs, and I have used leverage myself personally, and I didn't pay too much UDFI, if any. So I don't think it's that big of a deal, going forward. But everybody has to look at their deal and see exactly how that is. And if you want more details on it, 990T IRS form is the tax form you use for paying UBIT and UDFI taxes. And I have a chart on it here in a little bit. So let's talk about what the IRS doesn't let you do, because we talked about navigating those rules. Collectibles and life insurance. The IRS never tells you what you can invest in, only what you can't. So this is basically their small list of what you can invest in. The second thing they do is you can't deal with yourself. There's no self-dealing and no personal use. If you buy a rental property and it's in a nice location in your IRA, you can't go and use it because you'd be getting a personal benefit from it now. It doesn't matter if it's vacant, etc. It's just one of those rules. I can't lend money. Let me go to this next chart here. I can't lend money to anybody in the blue. I can't buy properties, or my IRA can't buy properties from my lineal ascendants, my parents or grandparents, my children or grandchildren. Right now, my mom says my aunts and uncles and cousins and brothers and sisters are part of my family. The IRS doesn't see it like that. Those people aren't disqualified. So the green are okay to lend money or buy property from. They're considered not disqualified persons. The people in the blue are disqualified persons. So this kind of shows it up. There's also a couple of other ones there. If you've got a trustee or a fiduciary of a trust or something like that, a lot of times, or a partner, in an LLC, those people are also disqualified. So always check and see who you're dealing with down there. But a good rule of thumb is if you're getting a benefit from it now, then it's probably disqualified or prohibited. All right. And the other one we get is, well, my son has an LLC and he's good at rehabbing. Can I use him to fix up my IRA house? The answer is no. And you can't buy, an example, you can't buy a house at State College and have your daughter or son move into it, right? Because they're disqualified persons. All right, so this kind of goes to your step-by-step, Ben, that you asked me. The first thing is you open up a CamaPlan account and you can fund that account, right? First one is with a contribution. The contribution limits are exactly what every accountant will tell you and financial advisor will tell you. They're all the same, whether it's a Schwab IRA or a self-directed IRA. Contribution and distribution rules are all the same. So you can contribute to it, or you can transfer money from your Schwab, Fidelity, Vanguard account into your self-directed account with CamaPlan. It is not a taxable event. There's no tax expended as long as you're transferring from a like account. Now, if you went from a traditional account to a Roth, you'd be paying the taxes. The other one that we see a lot of is rollovers from old 401ks. Sometimes an existing 401k has an option to let you do that, but basically you can take an old 401k and roll it into a self-directed account. And again, you want to roll them into like accounts. And if you do want to convert, I would convert them again after you roll them into there. And then you're gonna choose your investment, like in using your company as an example, you'd go in there and you'd pick a Comfort Capital investment, do your research on it, see how long it is, what the returns are going to be. If you're under 59 and a half, you're probably not going to use that money for a long time. So you probably don't care about the horizon. You probably want to look at what's safer and what's going to give you the best return. Once you do that, and you choose an investment, then you're going to fill out the paperwork for Comfort Capital paperwork, as well as paperwork from CamaPlan that says, hey, CamaPlan, I'm authorizing you to buy this property. We'll buy it. We'll vest it in the name of CamaPlan for the benefit of Jane Doe's IRA or 401k plan. And you'll fill out the paper for CamaPlan. It says, please initiate this. We will review the paperwork, have our client sign it as read and approved. We'll sign on behalf of the IRA, and then we'll, in step 5, send the money to the borrower, the seller, or the title company. In this case, it would go to Comfort Capital, and they would give us wiring instructions, and we'd be there. And then you'd sit back and go online, and you'll see, if it's quarterly distributions, you'll see the money come in quarterly. If it's monthly. If it's semi-annually, go online and check it. And it's, pretty
Here at Comfort Capital, we do monthly distribution, so our clients would see that hit monthly. And I'm assuming, does CamaPlan have like a login investor portal as well that they can manage?
Yeah, they have a 7-day, 24-hour, 365-day portal. Knock on wood.
And Carl, just as a disclosure, everyone, I'm actually a CamaPlan client, and I invest in, of course, our deals. So in our mobile home parks through my 401k that I had, historically through an existing employer. And so I actually believe in what we're talking about today. I do that. And I will say that I've gone through all, 6 of these steps, and it was very seamless. The portal is really clean, and your guys' team is extremely helpful. I'm someone who needs a little bit more hand-holding than others when it comes to anything administrative or onboarding. And so I will give a ton of kudos to your team, Samantha in particular, just for kind of helping myself and other clients that we have that have gone through you guys to invest with us. So it is, it's a pretty streamlined process, and you guys have set up the business in a way that makes it easy. And, I think similar to myself, our clients like, seamless, easy processes because it's already complicated enough, retirement accounts. So I'm glad you guys have invested the time and the effort and in the team to streamline that.
I really appreciate you saying that, Ben. But, and as we said earlier, the company was founded by myself and my sister, who's 15 years younger than I am, and lets me know it often. As coming from an investing family, we want it set up, for investors. So that's one of our taglines: for investors, by investors. And we just set it up how we like to be treated. So I appreciate you understanding that and seeing it. And congratulations, because now I see, going back to that other chart, you're on the way to tax-free or tax-deferred investments and being able to grow your net worth a lot more quickly as time goes on.
Absolutely.
So what does CamaPlan do? This is one of the questions you asked up front. The IRS requires you to have a third party to open up an IRA, and we're that third party. We're a neutral third party too. So please don't ask us how your deal is doing. Is it a good deal? I'll say go over and talk to, Ben or, some of the people at Comfort Capital who know more about those deals. Because there's no way we're going to know about all the deals all over the country all the time, right? If it's a house, talk to a realtor in that area, do your comps. If it's a private placement, look at the teams. And we do have a lot of free education on our website on how to do that. And I think we've even got a Comfort Capital up there, don't we? Sam, do we have Comfort Capital on our web?
Not yet, but we should.
We should
There
have
you
it.
go.
So soon. Yeah.
If we don't have you up there, we should have you, you know. I apologize for not getting you scheduled. You guys were opening up too many accounts. But we'll get you scheduled there. And then the other thing is we don't have any investment advice or products to sell like Schwab and Vanguard, et cetera. And then what we do is the reporting to the IRS that allows you to do these things. You know, the 1099s for distributions and 5498 for contributions. And we're not trying to replace your financial advisors or CPAs or attorneys. We're just trying to be part of your team of professionals. We're good at what we do, and we want our clients to do well. So we will take calls with your professionals. If you think that we said something or you can't find clarity or people want more information, we'll come in and tell them where to look at, identify statutes or court cases, etc.
Yeah, and I think to follow that too, Comfort Capital isn't a financial advisor in any way either. We just like to team with a group like CamaPlan to provide, you know, an opportunity for clients of ours who are interested in investing their IRAs or 401ks and are just trying to figure out how to get it done because it can be very complicated. So we're very excited to have, you know, a partnership with a group like CamaPlan to work together and refer clients to you guys to help so that it's a win for both our client and, you know, with us as we're a growing company. It's a great partnership here with CamaPlan. So we're excited to kind of have an answer for these questions for everybody.
And we love that you guys keep it really simple and
Yes.
break it down, and that it's just very straightforward. No sales pitches along the way. Because at the end of the day, we try to keep it really simple too. We rent trailers on lots.
Yes.
And collect rent, pay bills, and then pass through the cash flow. So this is a cool thing to just bring in as a part of an investment option for people that are frustrated with looking at their returns and all the fees that are just kind of consuming the upside on their returns that are in these big accounts. So it's really great. So yeah.
Yeah, no, I appreciate that a lot. I mean, and people always say, well, how much are your fees? And we tell them, if you buy an asset, and I don't care if it's 100,000 or 50 million, it's $300 a year for us to report on that asset and hold it and give you access to it online. So it's very, very minimal. And when you look at the savings that you're saving, it's great, from a tax savings standpoint. And obviously, if people are using their qualified plans, whether it be a 401k, HSA, or IRA, it basically boosts their return, right? If they're making, 10% on that chart we looked earlier, then that's going up, and they're using 100,000 of that money or 100% of that money instead of 60%. So you can just see how it's going to continue to grow.
And Carl, just on that, I did my due diligence as well on fees when I was, scouting the market and looking at CamaPlan and other self-directed IRA operators. And I will say from, me doing my research, the $300, you were below all the other competitors that I saw. I'm not saying that you guys are the absolute cheapest, and I looked at every single one, but the ones that I would feel comfortable investing in, people that have good reputations, your guys' fees were very much in line and really competitive. So to others out in the market. So just as a heads up, I did do my own due diligence before,
No, I appreciate that. And obviously we always ask people to do their due diligence and do it on us. we get asked that so much, we actually put a due diligence page on our website under Why CamaPlan, and you can go there and look at it. So visit our website, check out the things that you want to do. Does anybody have any questions at this point or want anything else covered?
One other thing that kind of comes to mind is, for our listeners, to give people kind of an idea from start to finish how long something like this might take. Can you answer that question? If somebody's with Fidelity or Ameritrade, how long does something like this typically take?
If they're at Fidelity or Ameritrade, most likely, and if they sell their assets before our transfer request gets there, they can do it in a week. If they have to sell their assets, based on our paperwork, which we don't recommend, that adds another 3 or 4 days. So I tell everybody 2 weeks, but there are some companies that take us 3 or 4 weeks. From when we request the transfer. And when you transfer, you can transfer all of it, or you can transfer half of it. I call that toe dipping in the overall, hey, I listened to this webinar, Carl sounded good, they said he went to Cornell and a rocket scientist, blah, blah, blah. Let me just make sure I get my money back. Return of principal is more important than return on principal. I've been taught through my life.
Sure.
So,
and who do they call at like Ameritrade or Fidelity if they're interested? And do their custodian, or who do they best call on that side to start the process?
Well, basically what happens is, you will, when you open up your account, if you're going to do a transfer from them, we put a sheet in there that says, give us that detail, attach a copy of your statement, and tell us how much money you want to do it. Do you want to do a partial, or do you want to do it all? And then we'll go and do that. We'll send out an email to our client that says, hey, we sent this over to Fidelity or Vanguard. Please follow up with them, because they're going to listen to you more than they're going to listen to us. So you can get that status with them, and you can call basically the person listed on your statement at Ameritrade, etc. And if you have any questions, call our office or Samantha, and we'll get you in touch with the right people. And we do try to follow up with that. And then when your money comes in, you are going to get an email that lets you know that your money has come in.
Okay, that's great. So you kind of help them and throughout the whole process with whoever they're with, and hold their IRAs or 401ks with.
Yeah, exactly. When we get that transfer request, we're going to send it over. Like some people, Fidelity and Vanguard will accept a fax copy. Other people want it mailed. Some people will accept an email. Some people won't take anything but a fax or an original in the United States Postal Service. So obviously things take longer, and there's nothing we can do about it. Some of them will require a notary or a specialized notary. That banks give out, validating identity and things like that. So we understand it. We try to pay attention to all that. But I would say at least 80% of our stuff comes in within, 2 to 3 weeks. Now, the other thing is, and we are different than anybody else out there, any of our competitors, is we do not charge an annual fee until you guys actually buy something. Right? Other people will charge you something when you have, once your money comes to the account. We don't do that. We don't want you rushing to buy an investment. We want you to do your due diligence on the investment. We don't want you worrying about, where's my money? What do I have to deal with Schwab for? Well, they don't think you're who you are. Your signature doesn't match. I don't want our clients doing that. when they're looking at an investment.
Oh, I love that. Yeah, that's really great.
So, get your money over just in case you need to put a deposit down on a house or something early, but get your money there so that you're ready to go. And don't worry about the fees because we don't charge them.
Awesome. Well, they'll be race ready to make an investment into a trailer park. We love that.
Gotcha.
Yeah,
So if
I
there's
think-
not,
Go ahead, Carl.
here's some other questions. If somebody doesn't have any, you can look at that and ask me which ones you like. I guess you just asked me the first one, right? And the
Yeah.
second.
What about switching gears a little bit? What about more of a hypothetical one for our investors? Since we are a manufactured housing investment firm, some of the questions that I've been getting from clients, and I'm sure others, when I get one question, I know there's probably about 10. And one of the questions I got was just about the overall market, and is real estate a good place to park money right now, especially when people think about retirement assets? And I'm not a financial advisor by any means, but just giving my own opinion and how I would think about this. If you look at what are the other options currently in the market, the stock market's hovering at all-time highs, and you have interest rates that are sitting at 40-year highs, and you have a lot of instability within the overall financial system, as well as and the political kind of atmosphere. And so for me, the stock market it always has a lot of risks. I think it has more risk today than since back in 2008. The other thing is just with and Carl, were you going to say anything there?
Yeah, I'm just going to say, since I, graduated college, when interest rates are going up, the stock market's going down. So until you're sure that the interest rates have stopped going up and maybe are coming down, I think it's probably a good idea to put your money on the sideline and buy back into the mutual funds and things like that, because I think a lot of stocks have been taking a hit. I guess the Googles and the AI and some of those other ones, 10 or 20 of them are good, and been going up. But I'm not good at the stock market at all. But I do think with interest rates going up, stock market's going down. I love real estate because you're going to get your rent, sooner or later on that. And you have appreciation and depreciation, but that's with anything.
So you're a rocket scientist. What do you think rents are going to do long term, like from here to 10 years? And just any multi, like apartment, single family rental, like a rental house, like what do you think that's going?
It's the tightest market I've ever seen. Supply is down. People with 3% mortgages do not want to sell their places and buy into 7 or 8% mortgages. So the overall supply is down. If you look at Florida, 1,000 people are moving into Florida a day. They're building homes, with 5 manufacturers, 3,000 homes in a platted area. So it really depends, location. Where is the right places to be buying real estate? In my opinion, I think you're going to see rents go up a little bit in some areas. I think they've probably stabilized now, but I've seen people raise their rents, and other people say that's too high and move out. And people have been sitting there with places empty for 4 or 5 months. But again, you guys are in that business. Where do you think the hot spots are?
So we're with you in that we think in better locations, you're gonna find them typically in the southern portion, like the Sun Belt of the country, where kind of like the bigger growth is. And so like we think of that as Arizona, Texas, and Florida as the big 3 there. And then, multifamily rents and apartment rents, they're kind of holding and seeing where I'd say people are kind of getting priced out, maybe going from class A to class B to class C. We like to think of ourselves as like the lower echelon, the most affordable option as manufactured housing. And we're seeing actually a chasm of rent growth for our space in that multifamily is kind of the rabbit and we're the tortoise, and that we don't pace real time where, apartments and even single family houses, you're gonna have a little bit more turnover than we do, in that, apartments are, call it 40-50% of the building turns over if you're operating at, a normal like market rate, all age community. You're gonna have roughly 40 or 50% of the building turnover, to where you can net that increase per year real time. Single family rentals are like 20 to 30%. You're gonna have turnover. And they're achieving what I'm hearing and what I'm gathering is they're achieving a little bit better and or a stickier rent increase right now than apartments, because homes are a little bit more preferred and desirable. And then our space is got like a pretty good chunk, probably 25% left in from like the next 2 to 3 years that we can increase rents to just catch up to where the apartments went, and then be market.
Yeah, workforce housing is at a real low right now, right? People can't get into those. I mean, you see the UAW, right? UPS all struck, and they're just trying to get money so that they can pay the rent, right? Because the interest rates are up. So you're 100% right. I think you're looking at workforce labor housing is in a real shortage. I mean, I see kids graduating college with big bills and, to pay back, and how are they going to do that and buy a house at today's market? It's, basically unaffordable without help from parents or grandparents.
Yeah.
Right.
I mean, I don't know where all that's going to go.
Yeah.
I mean, everybody's fighting that same battle. But
So you might as well keep all your money and not pay the taxes, so you can go to bat with 100% of your money you make.
Right.
Well, yeah, there's a lot to say for that. You know what I mean? How much money are you going to be able to save?
Yeah. So yeah, play the game smart right now,
Mhm.
and yeah, get out your ducks in a row, and then invest wisely. We believe in hard assets that you can go feel and touch. No matter how you invest through the different programs or funds or private placements, but that's what we collectively, our family has really focused on, just because it's like, hey, eventually we're gonna get the rent, or maybe it plateaus, but to your point, like, it's real. There's a door and somebody living behind the doors. It's like, you might as well focus where you really understand and believe, that's real.
Mhm.
Yeah, for sure. That's the name of the game right now.
Yeah.
I don't.
Well, Carl, with that, I don't want to take up too much more of your time. We're almost at the top of the hour, but how do we get in contact with you or Samantha? Maybe put up Samantha's contact information again. Whoever's listening to this call, thank you for everyone that joined the call live. Feel free to contact me as well. If you don't have a pen and paper to write this down now, we can always send you over Samantha's contact and or Carl's contact and get you guys set up so you guys can start taking control of your IRA accounts. So thank you again, Carl, Samantha. Really appreciate you guys taking time out of your day to speak to our clients. And thank you to everyone that dialed in.
Yeah.
Thank you guys.
Yeah, I really appreciate it. Sam, if you can, make sure you put your cell number in the chat there if you can.
Yeah, I'll do that right now.
So that people have it. And if they need any other information, let us know. And if anybody wants a copy of this presentation to discuss with any of their professionals, feel free to ask Ben or Samantha.
Awesome.
Great meeting you, Carl. Good to see you again, Samantha.
Thank you so
You
much,
too.
guys.
Thank you,
Great
guys.
information.
Thanks, everyone.
Thank you.
And Samantha, let's take a note to get them on a presentation because I really like where they're going and how they're talking about the market and where those, where they see opportunity in today's marketplace.
Absolutely. Yeah, we'll get something scheduled.
Sounds good.
Sounds
Thank you
great.
guys.
Thanks, everyone.
Thank you. Bye.